Now, in case you were enjoying this and you found this really easy, welcome to this slide. So what is this doing? Yeah, so those who have a mathematics background will look at this and say, no problem, all we are doing is using continuous compounding. Those who don't have a maths background will be praying that, oh God, I hope I don't see this on the exam. Okay, now, here is what I'm going to do. I'm just going to make a couple of general remarks. Okay, just like up till now, we have used discrete compounding. Generally, in the equity world, we assume continuous compounding. And all these formulas, they are just taking what we just learned. So, for example, what was the forward price for a simple asset? It was the spot into 1 plus R to the power of T. So this is using your regular discrete compounding. Okay. Now, what did we then say for an equity that pays dividends? For an equity that pays dividends, we said the forward price is S minus the present value of dividends, and this times 1 plus R to the power of T. Now, this item is analogous in continuous terms to saying this S is actually S naught. So this, if we are using continuous compounding, can be written as S naught into e to the power of minus delta T. This delta is the dividend rate. So the dividend rate might be, say, 3%, expressed in continuous terms. Okay, so that will be given to you in the question. So if the dividend is 3% continuous compounding, what will you plug in for this delta? 0.03, always in decimals. And then e to the power of R, this C sort of subscript or postscript stands for continuous. What do you think this R stands for? This is the risk-free rate, and what does the big T stand for? This stands for the total time of the contract. Now, I'm not going to cover this. And actually one more point. The value against the formulas that we talked about earlier can be expressed in continuous terms like this. Having said all this, if you look through all the examples in this reading, they don't use this, they use discrete. If you look at the questions at the back, other than a couple of parts in one or two questions, throughout they are using discrete. So that tells me that understanding the discrete part is much more important, even though the learning objective says you need to know this also. So what I'm going to do is, I'm going to create a small recording explaining the mathematics behind this. So you listen to that, and if you really want to, we can set up another session where we go over this. But I think the probability of this showing up on the exam in discrete, in continuous form is relatively low. But if it does show up, then, and you are completely clueless on how to deal with this, then just assume everything discrete and hope and pray that the answer that you get will be close enough to the right answer. It won't be that far off, especially with low interest rates. So chances are your answer will still be the closest to the correct answer. So if you see this, don't get stumped, do something. Okay. All right. Okay. So now moving on to bonds. And the good thing is that what we talked about before is all still relevant. So the forward price for a bond is equal to the bond price minus, what do you think we subtract? Yeah, it's the present value of all the coupons. And then what do we do after that? 1 plus R to the power of T. So do you know this in your sleep by now? So this is straightforward. What's the other way of writing this? Forward price is equal to bond price into 1 plus R to the power of T. and then you subtract the future value of the coupon. So the same concept. Okay, so let's now, actually this one, in the interest of time, I'll skip this because the concept is exactly the same as equity forward contracts. Instead of coupons, you are now, instead of dividends, you are now dealing with coupons. And if you look at the rest of these questions, it's all the same thing. So you will start with the price of the forward contract, you'll come up with the value of a forward contract, then what happens at expiration. Okay, so that brings us now to forward contracts on interest rates, which we affectionately refer to as, some people call them FRAs, some people call them FRAs. Okay, I prefer forward rate agreement, so FRA. Okay, now this is the formula in the curriculum. Okay, for a forward price and the value. Now, how many people in their right mind can remember this? Okay, you can't even remember all the, how many things there are involved. So my sincere advice is, you ignore this, but what I'm going to tell you is how to solve the problems. Okay? And I'm going to show you that it's quite straightforward. Okay, and actually it's also, half of this you've already done in level 1. So it should not be too bad. The pricing part you did in level 1, the valuation part is the value add in level 2. Okay, so forward rate agreements. A corporate treasurer needs to hedge the risk of the interest rate on a future transaction. The risk is associated with the rate on a 180-day Euribor in 30 days. The relevant term structure of Euribor is given as follows. So you are given these rates. Okay, now how many people remember from level 1? So this is what's going on here. So as a quick refresher, what is a forward rate agreement? It is where the long party gets into a contract to borrow a certain amount of money at a certain point in the future for a certain period of time. Okay, so this particular example is, the risk associated with the rate on 180-day Euribor in 30 days. So this is saying if we are now at time 0, after 30 days, 180-day Euribor means, so that's 30 over there, so this means 210 over here. So at time 0, we are getting into a contract on a 180-day loan, which starts, so that loan starts 30 days from today and ends 210 days from today. So either you can write it in terms of days, or if this were months, then it would be starting at month 1 and till month 7. So how would you write this in the FRA terminology? Do you remember? Yeah, you can write this as a 1/7 FRA. Okay, straight out of your level 1 reading on forward contracts. So this is a 1/7 FRA in terms of days. You might write it as 30/210 FRA, but generally they are written in terms of 30-day months. Okay, so this is your terminology. Now determine the rate that the company would get on a FRA expiring in 30 days. So what is that FRA rate? So if we are doing this, what rate will we get given these rates are already in place? That rate is the price of the FRA. Okay, so that rate is analogous to the price that we have been talking about so far. Now, how do we do that? Let me just show this in, let me just clean this up a little bit so I have all my space. Okay, so the way we are going to do this is as follows. So 0, 30, so 0, 30, 210. Okay, we are told that 30-day Euribor is 5.75 and 210-day Euribor is 6.15, and we need to find the rate for this period. The way we do this is, if you can use two possible strategies for investing $1. So imagine $1 of notional principal. So if you invest $1 over here for this entire 210-day period, what rate will you use? The 210-day Euribor. So $1 invested at 6.15 will give you how much money at the end of 210 days? It will give you, so $1 will become 1.0615 to the power of 210 divided by, let me see if they are using 360 or 365. Generally, okay, actually a quick correction right here. So what I began to do was compounding. The convention in FRAs actually is to do things slightly differently. It's to use, in general with FRAs, what we say is we use simple interest. So it would be 1 plus 0.0615 into 210 over 360. So the 0.0615 is an annualized rate. We change that into a 210-day rate by doing 0.0615 into 210 over 360. So this is the convention with forward rate agreements. So do you agree with me? $1 invested at time 0 will become this much money at the end of 210 days. Okay. Now this should be the same as taking $1, investing it for 30 days, and then taking that money and then investing it again at this rate. Right? So both in a no arbitrage scenario, the strategy 1 and strategy 2 should give you the same amount of money at the end of 210 days. So if you take $1 invested for 30 days, how much will you have? You will have 1 plus the 30-day rate, 0.0575 multiplied by 30 over 360. So this is how much money you have at the end of 30 days. And now this rate, let's call it X, okay, from our good old algebra days. So this is being invested at a rate X, where X is the, let's say, your return over 180 days. So this would then become into 1 plus X. Okay. Are you with me on this? So it's a simple equation, relatively speaking, much simpler than that. Okay. So you have X and you figure out that X is Okay, what I'm doing is I am actually trying to make life even simpler. I'm calling X the 180-day rate. So once I find X, that will be a rate for 180 days. And then to annualize it, I just need to double it. Are you with me? Okay, so when I actually figure out X, I get, so X is actually equal to, I'm taking a shortcut here, X is equal to 0.0619 divided by 2. Okay, and then, so this number, if you've calculated this from here, this represents a 180-day rate. How do I annualize this? By simply squaring or doubling? So given that we are using simple interest, I simply double it, and then I know that the 180-day rate 30 days from today is equal to 0.0619, which is equal to 6.19%. So this is the FRA rate, In other words, this is the price of the 1 by 7 FRA. So the price of the 1 by 7 FRA is 6.19%. How would we say this in simple English? We would say that if I want to borrow money after 30 days for 180 days, my rate will be 6.19%. And since I'm not stating a holding period rate, the default is that 6.19 is a annualized rate. Do you remember this from level 1? Okay, hopefully you do. Okay, this is exactly what you did in level 1. You did this in fixed income, and then you also did this in derivatives. In fixed income, you called it a forward rate. In derivatives, it was called a FRA. Okay, it's still called an FRA. Okay, so this is it. What do you think the next step is? Yeah, so I'll set the context on this messy slide, and then on the next slide we will do the calculation. Okay, so at what time do we get into this forward rate agreement? At time 0. So at time 0 we are locking in this rate. What's the long party getting? The long party will be borrowing or lending? Yeah, the long party is borrowing, the short party is selling money, which means lending. Okay, now I'm also going to set the context for why this is so important. Banks get into forward rate agreements. Banks also have a requirement to mark to market. So if I'm a bank and I have several forward rate agreements on my books, on day 0, when I get into the forward rate agreement, what's the value of that contract? Value is 0. Let's say 15 days into the contract, interest rates have gone up. Okay, do you think now that piece of paper that says that I have a right to borrow at 6.19% on this day, does that contract, that piece of paper have value? Yes. It does. And conceptually, if I went long, so I had a long position and interest rates went up, did I as the long party gain or lose? Gain. So always the long gains when the price goes up. In this context, the price went up, i.e. interest rates went up, so the long party gained and the short party loses. Just to throw a quick monkey wrench at you, let's say you were long on a bond and interest rates go up. Then do you gain or lose? Then you lose, because there the underlying is thought of as the bond. And bond prices go down when interest rates go up. In this particular case, you are long on a rate. So when you are long on a rate, you gain when the rate goes up. Okay, so even though the economics of bond and interest rates are perfectly are correlated, actually negatively correlated, you need to be clear about what the underlying is on a contract. All right, what do you think is going on here now? Rate. Okay, so what determine the rate that the company would get on a FRA expiring in 30 days. Actually, this is the calculation I did on the previous slide. The part A was simply saying that it's a 1 by 7. So part B is coming up with the price or the rate which we did. What do you think part C will be? 15 days. Okay, now 20 days later, the interest rates have moved significantly downward. So just off the top of your head, did the long gain or long lost? Long lost. Okay, we are given the new rates. Notice that we are given now the 10-day Euribor and 190-day Euribor. So if the CFA Institute wants to have some fun with you, they'll give you several rates and then you have to pick which particular rates to use. So on our picture, what's happened? So we started out on day 0 and we said that we will initiate our loan on day 30 and it's going to be a 180-day loan. Now we have moved forward and we are on day, so we are now sitting here. So now what are the relevant rates? The 10-day Euribor and then from here to here is the 190-day Euribor. Now I'm going to at least set the context before going through the calculations, which are not too bad once you understand the context. You've already understood the price of the contract and how to come up with that. When you are at this point in time, the concept is you say, okay, if I were to get into a forward contract at this point, so if I were to sign a new forward contract on this day for a loan that's starting on 10 days from today, which is 30 days from the original time zero, for that same 180-day period, given the current interest rates, what would that new price be? Okay. And then the value of the contract will be based on the differential between the original price, the new price, and then that differential multiplied by the notional principal. So note that you are now given a notional principal. Why? Because now there has to be a dollar value. So if interest rates have changed, clearly the long interest rates have gone down, the long has lost, the short has gained. If the notional principal was $1, then that amount would be almost irrelevant. But this is substantial. The notional principal is pretty significant. It is 120 million. So I want you to do this now. You are sitting here at day 20. I want you to calculate that if you were to get into a forward rate agreement over here, what would this X be? What would the rate be? Okay, you know the rest, mere mortals. Let's you also come up with this. Okay, so does anybody have an answer yet? Okay, so let's do this very fast. What's this this X rate, which means that if on day 20 you are to borrow money after 10 more days for a 180-day period. Again, think of it as two possible strategies. Strategy one is $1 borrowed for this entire period. That should give you, or $1 invested for this period should give you the same as $1 invested for 10 days and then invested again at that rate. So the way you can do that is, so if $1 is invested for this entire 190 days, how much would it be? It would be 1 plus 0.0595 into 190 over 360. This is equal to, so this is equal to $1 invested for 10 days and then reinvested for 180 days at a rate of X. So this is equal to 1 plus 0.0545 into what? 10 over 360, and then this amount is reinvested at that rate X. So reinvested at 1 plus X. Now when you solve for X, you will get X is equal to 0.02984. Okay, so that is this rate over here, 0.02984. Now the X that we got before, where we invested, now I'll just draw this very fast. So earlier what happened? So earlier you had 0, day 30 and day 210. Earlier the rate that we got for this period was actually 0.0309. So that was the rate before. Now that we've moved forward, the 180-day rate is this. So what's the difference? If you take the difference between these two numbers, 0.0309 minus this number, 0.02984, you take the difference and multiply the difference by 20 million. The amount that you get is equal to 22,000. And this 22,000 is now the value of the forward contract. But who has this value? So this is a positive value for whom? the interest rates came down. When interest rates come down, who benefits? Short. Interest rates come down. When the price goes down, short benefits. When price goes up, always long benefits. So that simple relationship never changes. So this is the value of the forward contract. Okay, does it make sense? So all time value of money. And hopefully, again, I'll re-emphasize that is simpler than, all that we've done. According to the CFA Institute, this is the formula that they have used, but you really don't need to memorize this unless you really like memorizing such formulas. All right. Okay, we are getting close to the end here. This again should look familiar. Do you remember forward contracts on currency? Okay, so you studied this in economics. It's coming back to haunt you. It's not too bad though. Okay, so I'm just going to set a quick context on this, and then you can practice the question at home, plus you can look at your economics slides and lectures. Okay, so a quick refresher. Now, what does a forward contract on currency mean? A forward contract on currency means that you are committing to buy a given currency at a given rate in the future. To keep things simple, let's say that we are buying dollars. Okay, so if I say that the spot rate is 95 rupees to the dollar, what is the base currency? 95 rupees to the dollar. The base currency is the currency of which there is 1 unit. In our simple example, the base currency is the dollar. The foreign currency is also the dollar. Okay, so if you recall, the forward price, now this is based on the interest rate arbitrage relationship. The forward price is equal to the spot price, and if the spot is expressed as a counter currency divided by base currency, or in our example, the rupee, which is our counter currency, divided by dollar, which is the base currency. So you have the spot rate into 1 plus the interest rate of the counter currency, which is the rupee, divided by 1 plus R for the dollar, which we are calling the base currency. The base currency always goes, the interest rate of the base currency goes in the base or the denominator. Does that sound familiar? Actually, the question is whether base is the DC. The DC stands for domestic currency. Okay, and the reason I don't like this DC FC relationship is that sometimes your domestic currency can be the base, and sometimes your domestic currency can be in the numerator. Okay, so whenever you look at a quote, the first thing you should understand is, in this quote, what is the base currency? The base currency is the currency of which there is 1 unit. So the moment you see a spot rate quoted at 92 rupees to the dollar, immediately the first thing that should come to mind is not foreign currency, domestic currency, because that changes depending on what nationality person you are speaking to. But the base currency, whenever a quote of 92 rupees to the dollar, the base currency is the dollar. That means that the denominator rate will be the dollar rate, and the numerator rate then is the rupee rate. So this spot rate, whatever the base currency for the spot rate is, that rate is in the base or the denominator. Okay, so just hammer that in. Any other way of remembering it, you are welcome to do so, but the chances of messing it up on the exam are high. It happened to me. Okay, so after that, I just remember this one thing, and then it's clear. So the base currency is in the base. Okay, that should be easy to remember. So this formula should look familiar. Now, is this the price or value formula? This is the price of the forward contract. So if I say that I'm going to buy dollars at 95 rupees to the dollar, that's the price of the forward contract. As you might imagine, this can also be expressed in terms of continuous compounding, but we are not going to worry about it. Just that should be good enough. And now what's the level 2 value add? This you've studied in level 1, and you have also seen this in economics. So what's new? Okay, what's new is the value. If you look at the value, I'm going to just help you memorize the formula, and then you can go back home and practice the problem, or if you are listening to the video, pause this and do the example. Okay, so the value is, the way you can remember this, in general, how have we talked about value? The value is equal to the spot rate minus the forward rate over 1 plus r to the power of big T minus little t. So everybody remembers this. Okay, now let's take the right hand side, f over 1 plus r to the power of t minus t. Now take the context of Pakistan or whatever country you are in. So let's say that this r is the risk-free rate in your country, okay, which in our example would be the rupee. Okay, so risk-free rate in Pakistan about 12%. So this r that is associated with the forward rate is the rate in our currency, which is the rupee. Okay, now what about this guy, the spot rate? What did we do when we were talking about say bonds, or when we were talking about stocks? What did we do from the stock price? We minused the present value of the dividends. Now think hard about this. We are not talking about stocks anymore. Instead, we are talking about, let's say, think of the dollar as an investment. Okay, just like on a stock you get a dividend, on a dollar investment you get the dollar interest rate, right? So since you are getting a dollar interest rate, something related to that dollar interest rate needs to be pulled out, just the way we pull out the dividends of a stock. And hence, the way you do that is you just divide by 1 plus r. Now this rate is which rate? It is the dollar, it's the risk-free rate on the dollar. Just like on a stock you are getting dividends, on a dollar you are getting the risk-free rate to the power of the amount of time still remaining for the end of the contract, which is big T minus little t. So at any point t, that is the value of the forward contract. Now if you get into a forward contract and spot rate goes up, so the rupee dollar exchange rate goes from 95 to 100, who gains? Kawal? Spot rate goes up, who gains? Okay, just remember, the price goes up, long gains. Always when the price goes up, long gains. Okay, so the one who is in the contract to buy the dollar. Remember, you've not bought the dollar, you are in a contract to buy the dollar at a future point in time. Okay, so can you memorize this formula? So memorize this formula and use this formula to do example 5 in the curriculum. We will not do it right now. Okay. Okay, so you solve this example 5. The same concept runs throughout. And this is the last concept now. Just sit back and relax and listen to the concept. When you get into a forward contract, do you think there is any credit risk? What does credit risk mean? Credit risk means that the counterparty might not fulfill its obligation. So, let's say you are a bank and you have taken a long position on a forward rate agreement. Okay, if you are winning, which means that interest rates have gone up, so your forward rate agreement has positive value. Okay, so if there is positive value, do you have default risk or credit risk? Yeah, anytime you have something, when your value is positive, then there is credit risk because the counterparty owes you. And what's the magnitude or amount of that credit risk? It is based on the value that you have. So if the value of your forward contract is $22,000, then what's the credit risk exposure? It's $22,000. So the simple point is that if you are winning, the amount or the value of your contract is your credit risk exposure. What if you are losing? In other words, you are the short party and you are the short party in a FRA and interest rates have gone up. Yeah, so does the short party have any credit risk? No. So the good thing about losing is at least you don't have any risk of losses because you are already losing. Okay, so that's the good thing. If you are negative, then you don't have to worry about credit risk. Okay. Okay, so we are talking about credit risk. Okay, so the point is that if you're worth, if I owe you something, right? So you are the one with the credit risk, not me. That's it. And if I owe you $10 million, then the exposure to you, credit risk exposure is 10 million. Okay,
equal to just the value.
Yeah,
due to market.
Yeah, after that the value will change due to market movements, but there is nothing complicated about this. Just read this paragraph, and if you just followed what I said, that's all you need to know. And the final point, which is not even a learning objective, is the role of forward markets. I will simply read this and then we will end this segment. Forward markets play an important role in society, providing a means by which a select clientele of parties can engage in customized, private, unregulated transactions that commit them to buying or selling an asset at a later date at an agreed upon price without paying any cash at the start. Forward contracts also are a simplified version of both futures and swaps, and therefore form a basis for understanding these other derivatives, which we will start studying in the next segment. What you need to do now is go back and practice all the questions in the curriculum. We'll follow the sequence that we have followed in this class. So nothing difficult, but the practice is necessary. That is it.